and welcome to this special Economic Times presentation on India Startup Day. India has emerged as the third largest ecosystem for startups after the United States and China. And as per government data, approximately 50% of the recognized startups in India are based out of Tier 2 and Tier 3 cities, contributing to the country's economic growth. And while the number of unicorns may have dropped and funding is of course tight, startup businesses across sectors like fintech, health tech, agri-tech, SaaS continue to emerge and power what many say is India's techade. And today we bring you a special conversation with a young entrepreneur who's pioneering a category-defining business. Deputy editor of ET Tech and Economic Times, Digvijay Mishra, speaks to Adit Palicha, co-founder of grocery delivery service Zepto.
So welcome everyone. Today we have Adit Palicha, co-founder and CEO of Zepto with us at the ET India Startup Day Summit. Welcome, Adit.
Yeah, it's wonderful to be here. Thanks for having me.
Yes, I'm glad you are here. Though I'm sure Zepto is a fairly well-known name, but it's among the hottest startups in the quick commerce space, which is aggressively expanding across the country and has disrupted how a lot of things from grocery to other daily essentials are delivered to us. But today we are here to talk about how Adit and Zepto have kind of scaled in a very shorter period of time and disrupted the whole space. At a time when of pandemic, we were seeing demand people moving online for grocery and other essentials. Adit, you both you and your co-founder are very young, relatively younger, if I may say so. And you were also among the youngest startups to reach the 900 million valuation and many other feats. How has been the journey so far, right? I mean, you guys are still in your early 20s. Do you want to take us through that?
Yeah, and again, it's wonderful to be here, and we really appreciate the feature. You know, for us, the journey has obviously been very interesting. It's been a pretty crazy 17 months or so of building Zepto. And, you know, the journey for us has been, I think, in the early days when we realized that there's this product that we had found was incredibly compelling for customers. People loved it. People were using it extremely frequently. They were moving a lot of their baskets to a fast delivery use case that was fresher and had, you know, larger assortment than most options. You know, that's when we took a step back and said, okay, this business is something that needs to scale. Customers love this product. We love this product, but it is a very complex supply chain oriented business, right? And for us to scale aggressively and do it in a short period of time, we need to bring on board the best of the best talent. Not just because we wanted to build a great company, but also because we wanted to accelerate the learning curves, right? If you're going to grow 200x in 1 year and you make a mistake, at the end of the year, that mistake will be 200x bigger. So we wanted people that could accelerate our own learning curves in supply chain and marketing and category and multiple other fields as well. So that, although Kemal and I were slowly trying to pick up the principles of supply chain theory through our own first principles learning, right, we figured it would be much better to have someone with that foresight, with decades of experience. And so we hired some senior folks that were solid in supply chain, marketing, category, tech, etc. Right? And so that was the first part of our journey. With the leadership team of that quality, we were able to build a team underneath them and attract talent a lot faster. And that talent was able to go through the journey of scaling fast, right? And so we ended up launching hundreds of dark stores, these facilities where we deliver groceries where we deliver groceries from. And we were scaling across the country, doing eventually in 16, 17 months, we went from zero to thousands of crores in annual sales, right? And so it's been a crazy journey in that way, but more importantly, with a team of that quality. And as the blitz scaling journey was started, the leadership team could take a step back and focus on everything that's not oriented towards just scaling the company, right? And for us, we knew that the blitz scaling part was happening independently. And so we said, okay, what are the important parts that are not related to the scale-up journey that will be critical a year, 2 years, 3 years from now, right? So we were able to focus a lot of time on, building the right controls of the business, building the right clarity and rigor on unit economics, and building a pretty robust compliance processes, especially for a company this young, right? And so, yeah, I think we're reaping the benefits of that today, but it's been a pretty wild journey for sure.
Right, of course, of course. So also, the time you guys started, quick commerce was still a relatively unknown term in India, at least. Globally, we had started seeing. So tell us, why did you choose this space? Like, why delivering anything in 10 minutes instead of, and obviously it has a focus area in grocery and essentials. Why not anything else in the consumer goods space? Why this?
Look, for us, I think we got into the grocery space as two bachelors that couldn't go to college in the US because of the pandemic. So we found ourselves back in Mumbai.
Yeah.
And in the first lockdown, the most painful and clearest problem statement that we had was getting groceries. Right, most of the offline options were shut or not available. The online options were taking 7, 8, 9 days to deliver in many cases in the first lockdown. So getting those daily essentials and groceries was the most apparent pain point in front of us, and not just for us, but our newfound neighbors in the place that we moved into, right? And we couldn't find an apartment, by the way, because I think most landlords were not very keen on two bachelors in a nice society in Mumbai. So yeah, I think that was the journey that we had, and that's when we started focusing on groceries, a problem statement that we were experiencing, and we found our neighbors experiencing, and we said, look, how can there not be a product that people are excited about? We did not meet a single person in the customers that we spoke to around us that was really, very excited and very happy with the product that they were using, right? Whether it was online or offline. People will say, yeah, I might use an online delivery service, but it was underwhelming, and people were not extremely loyal. There was a lot of problems that were, brought up. And so we said there is something, for something as large and frequent as grocery for the individual customers, in many cases, the majority of the household spend is going to grocery. How can there not be a product that people love, right? Effectively? And if people have done it in food delivery, and people have done it in ride sharing, and people have done it in multiple other categories in e-commerce, why is this the category that's lagging behind? And so that's when we picked up grocery. How we ended up going into that rapid delivery lens into grocery, frankly, we just spoke to customers, right? And initially, we were building a delivery service that was 45 minutes to an hour. And as that scaled, we were doing it through this sort of local Mad Friday model where we were delivering.
Right.
Actually, initially started with Kevalia and I in rickshaws delivering and cycles, and then eventually sort of scaled that a little bit to a couple thousand orders a week. And that's when we spoke to customers, said, look, we'll use your service. But frankly, we're only using the service because there's a massive lockdown. Right now, 45 minutes to an hour, and the other issues that come from the Man Friday model, small, limited assortments and pretty low reliability of getting the right items and getting the right quality. Most people said we're going to use it. It's a lockdown. We don't have an option. But the second this is over, we are going back to what we were used to. Right. That's when we took a step back and said, okay, how do we make this customer experience a lot better? And we tried multiple things. Eventually, we started experimenting with dark stores, right? And we figured that, okay, if we work with dark stores and partner with folks to help us build this out, right? Not only does it help us streamline the entire operational process to deliver much faster, which ended up being a big value proposition for customers that were used to getting groceries done as an 1-2 hour chore. Now they can get the entire thing done 3, 4, 5 minutes. Adding items to the cart, 10 minutes is done. That line item on your to-do list is checked off in 15 minutes. Not only was that extremely compelling to a lot of people, but we were also able to use the dark store model to expand our assortment significantly, do it with a lot more reliability and quality control, and also scale with frankly better unit economics. And so for us, that's when it became fairly apparent that we should be doing what we're doing. So it was more of a iterative process. Spoke to customers, tried different models. We experimented everything from the Man Friday model to a SaaS-based model, and eventually this is what we found. And we didn't really know much about the European guys and the American guys that were trying a similar model at the time. It was more so our own journey that helped us stumble into this model.
Okay. I hope now that you are one of the most recognized startups, your housing problems are sorted in Bombay.
Not really.
Oh,
like it's still a conversation with landlord.
Okay, and we'll catch on that separately. While everyone knows about your Stanford dropout story and all that, but not many people know that you were involved with a previous startup also before Zepto. So that shows that, you guys have been kind of always thinking on these lines and to start your own venture. Why don't you tell us, like, what does entrepreneurship mean to you, and even a little bit about your previous startup? How did that go, and then you came to Zepto?
Yeah, look, so both Kevalia, my co-founder, and I, right, both of us had dads that were originally engineers, and so that love for building was instilled in us very early on. And KV pretty early on, 12, 13 years old, taught himself how to code, got very good at it, actually, surprisingly good. I was trying the same thing, but was never as
Right.
technical as he was. But the two of us sort of naturally experimented with different projects and different ideas because we found it fun, right? As teenagers growing up.
Right.
Kevalia built a tool that, like, an OCR tool. I think he was 15 or 16. An OCR tool that helped people scan textbooks and make it an audiobook.
Okay.
Basic idea, right? But built it out, and we I experimented with other small things, everything from program that could summarize privacy policies for you to other projects that were in mind. But eventually, when we were 16, we started a project that was reasonably substantial. It was a ride sharing platform for school commutes. Ended up scaling to a couple dozen schools in our city, and yeah, that was a reasonably successful project, right? And that's when we took a step back and said, wow, this hobby of ours of building out interesting technology products can actually be a very rewarding career path. And that's how we took the next step into saying, okay, if we're getting the hang of building products, how do we build the organizations around those products? How do you build an Amazon or an Airbnb or an Uber or a Flipkart? And we figured the best place in the world to go and learn that would be Silicon Valley in California, which is why we applied to study computer science at Stanford. So yeah.
Okay. Interesting. One of the things you mentioned early on, right? Like, and we all witnessed it also when Zepto was started, there was crazy amount of capital that was available in Indian startup ecosystem. Even throughout at least the first half of last year, capital was fairly available.
Sure.
Now we are in a different situation. All of us know about it, where capital is very hard to get, and probably things will be slightly more tougher in the next 6 months at least, is what a lot of people are saying. So with that view in right now, do you think you wish you wanted to do something differently when you started? What are your thoughts in hindsight?
Yeah, and I know it'll sound like spin, right? But the reality is, when we started this business, we realized that we were building something massive, right? We're talking about grocery, and we're talking about a space that has been a big question mark for e-commerce for more than a decade. Nobody's been able to crack it. The existing products in the space really are a very, very small fraction of the potential of online grocery. Companies that have scaled to even $1 billion, $1.5 billion in sales, right? It's nothing in online grocery. It's like it's just like scratching the surface of the surface, right? And so you're talking about a category that's got penetration in basis points, where other categories like electronics and fashion are at least at the 5 to 10% level, and have got clear visibility to getting to 35-40% in the next 10 years. And so when we realized that, wait a second, we build a product that people love in the biggest category in the country. First of all, awesome. Secondly, there are going to be a lot of people interested in this, right? So we realized we needed to get good at two things if we wanted to really put our foot in the door and winning. One is we had to get good at raising capital, right? And doing that fundamentally doesn't mean whining and dining investors, and being able to tell a good story. It means actually having a control of your business when you can give thoughtful investors comfort that you're building something real. That's number one. And number two is we had to be extremely capital efficient. So even if we raised hundreds of millions of dollars in our first year, which we did, even if we did that, the large guys that would get interested in this space, and they would inevitably get interested in this space because of how exciting of an opportunity it was. The large guys that would get interested in this space would always have more capital than we do. And so if my largest competitor is going to have 3x more cash than I do, even after I've raised $360 million in 12 months, so they have 3x more capital, I've got to be 4x more capital efficient, right, to win. And we genuinely realized that on day one, and not independently. It's also because Suvir from Nexus told us that in pretty explicit terms. And so So yeah, I mean, I think we actually on day one, if I answer your question, looking back, could we have been more prudent, more capital efficient? The most expected answer could be yes, but I actually think we did a reasonably good job. And obviously, we did invest a lot of money. We opened a lot of dark stores. That does require capex. That does require some amount of money in marketing. But fundamentally, do we do it with the right systems and unit economics? I feel so. And we're sitting in a position today where, frankly speaking, with a much younger business and with a lot less capital than other players not in consumer internet.
Yeah.
We are not flailing and struggling and flatlining, and we're doing well. And the only reason why is because we're seeing mature dark stores actually turn cash flow positive, and they're doing it. If you look at Nielsen's data, the average time it takes for a new supermarket in India, Reliance Fresh, More, Spencer's, DMart, average time it takes for a new supermarket in India to turn profitable is 18 to 24 months. Our dark stores are turning profitable faster than that and fully loaded. And so we're feeling good, right? If I have to be very honest with you, and our numbers are reflecting that. Do I think that we could have made decisions better? For sure. And if I had to touch on some of the things that we could have done better early on, we could have, there's some wrong hires that we made. There were, I would have liked to raise more capital right earlier on. I think 360 in 12 months was tough enough, but could we have gone for more potentially? But do I think that we were fiscally irresponsible? Right? I actually don't think so. I think a lot of companies were. If there's one thing I'll give us credit for, and we've definitely made mistakes, but if there's one thing I'll give us credit for is that if you walk into the company today, you'll get a sense that we're actually building a real company. This is a lot of fiscal discipline that's been embedded here. So yeah.
So it's interesting, even when money was available relatively on easier terms in the maybe 18 months ago, you guys were young founders, right? How did that whole conversation go? I mean, you have raised from YC as well as its continuity fund and some of the other global investors. How do you sort of handle this conversation? These are two young folks. Do I want to put my money in them? Like, how did you handle that?
Yeah, I mean, that's a great question. And that was all the more push to have more substance, right? Like, for us, the only way to get someone over the line, right, in a business as competitive as this and with founders as young as we are, is to have really rock solid numbers. And not numbers that we just throw in the air, right? Numbers that are diligenced by big four accounting firms, numbers that are a lot better than what people expect in this industry, best in class. When you throw overwhelming substance at people, even investors that are skeptical, the good ones are willing to take a step back and say, hey, am I missing something? Right. And so that was the solution to our problem. Great numbers, both on the growth side and on the P&L front, that people were not expecting. And that was what gave people the surprise that ended up leading to a successful fundraise.
Okay. So how do you think the next fundraise conversation is going to be? You guys are no more teenagers.
I don't know if being 19 years old or 20 years old changes the dynamics for investors. But to answer your question though, I mean, it's a serious question. The answer, obviously the next fundraise, like for every company, will be more indexed on profitability and the P&L. But frankly, if you look at the types of investors that we've raised from, right, most growth companies in the country have got a different brand of investors, more hedge funds, more aggressive. We don't really have that. I think I would like to believe we've got folks like YC that are a lot more thoughtful. Silicon Valley folks have invested in some best-in-class companies. In India, they've invested in really high-quality companies, Razorpay, Grow, etc. And they've already done 3 deals: Razorpay, Grow, and Zepto. So we're happy to be in that. In the company of 2 companies, like in that group of companies.
Right.
But yeah, so I think our fundraisers were anyway indexed on the P&L before, but even today will be more so indexed on that. And yeah, I mean, it'll be a function of, if you're raising this money, what are you going to do with it? Because I think we're beyond the point where we raise money just for the sake of having more months to live. I don't think we're in that position anymore. We've gotten to a little bit more maturity as a company. Now it's about, okay, if you're going to raise money, what is the purpose of this capital? And we're going to use it in the right way. So, yeah.
Okay. Adit, actually, a lot of entrepreneurs and startup executives who want to start up will be watching us. What is your advice? Like, how to, even at an early stage, the macros remain same. What's your advice to them in terms of going about fundraise?
Yeah, I mean, advice specifically for fundraisers. Look, I would say that at the earliest stages, investors only care about the founders. Good investors care about the founders, right? Do they see these people being able to build large companies and to be able to do it with intellectual honesty and thoughtfulness that leads it to actually creating some value, right? And you have to be ruthless and ask yourself, like, am I going to be, do I see myself building this? Is this the kind of business that I want to build? And if there's no founder market fit, then you're going to always struggle to raise, because at the earliest stages, investors are very good at identifying at least who are the founders that are really going to throw everything at their business. And so if you're going to fundraise, make sure that it's something make sure that you're clear about what you're getting into, and make sure that you know that the business that you're building is the business that you can say hand on heart, you're happy to make your lives work. So yeah, because that's what investors will want.
Yeah, of course. And it's a follow-up to that. I mean, of course, you are one of the unicorns right now in India, very close to the unicorn tag, so to say. But I've in the last 6 months, among while the kind of hype is settling in India startups, I'm seeing this term being used by a lot of entrepreneurs and investors about it's not about valuation but creating value. What do you have to say to that, and how do you kind of go about it?
See, at the end of the day, the only value that's created is with actual cash flow and profitability. You can't be valued as a multiple of revenue forever, right? It'll never happen. Right. And so the very simple answer to that question is, you're an asset like any other asset, whether it's real estate, public equities and startups, they're an asset. If you're an asset, you need to be generating something, right? And then you get valued as a multiple of that, where that can go to. And so to build your value, the answer to that is just increase your ability to either make profits today or show a very clear path to making profits tomorrow. And doing that in a way where you can also not just show, see, the one thing that I disconnect with investors a lot is if a company is profitable, it doesn't mean it's worth billions. You can be marginally profitable also, and you should be valued on that low level of profitability, right? And so if you're also going to build a company that's profitable, make sure you can generate a lot of it, right? If you want to build something that's really valuable. So the way that I define value creation for startups that are not extremely mature, large, enduring public companies is, increasing the clarity of getting to profitability and increasing the scope of how much profitability or how much profits you can generate when you do eventually get to profitability, right? So it's growing the business and doing it in a way where your profitability potential is improving in the long run, and showing that path exists. And in our case, that means showing dark stores that are turning cash flow positive, and with a clear glide path, and then to say that, okay, my mature dark stores are cash flow positive, and today I'm spending money on my early dark stores and launching more of them in more markets. So yeah.
Okay. So how, I mean, of course, we are talking at a time when quick commerce as a model across companies, they're cutting cost at every sort of possible chance. And they need to do that because it has been a very cash guzzling business so far, what we have seen. Sure. And you mentioned, right, like from being, GMV multiples to now coming to PAT. How are you doing that in Zepto? Like, has that process begun? Has that always been part of it? Help us understand.
A process of cutting costs. Look, there are two philosophies of cutting costs, right? One is you can shrink yourself to lower costs, right? Or the second one is you can drive sustainable operating leverage. Right? To my mind, it's a flywheel effect, either in the negative way or the positive way. Right? The negative flywheel is, okay, I need to improve my P&L, right? And I'm talking about in our case, right? I need to improve my P&L. I'm under a lot of pressure to reduce burn from my board, okay? And I want to do it quickly. I don't want to go into the depth of my backend supply chain and how to drive operating leverage there. So what I'm going to do is I'm going to put my profitability problems on my customers. I'm going to increase my delivery fees and reduce my discounts. And I'm going to start taking a hit in top line as a result, right? Now my top line is reducing, but sure, my delivery fees are up, my P&L is looking better. Great, fantastic. Now your top line has gone down, so your fixed costs as a percentage of revenue increased. And wait a second, your contribution margin in your P&L has not really improved that much because your fixed costs are getting heavier and heavier. So now you need to increase your delivery fees even more, which will reduce your top line even further, which will hurt you on your fixed costs even more. And now all of a sudden, the delivery drivers that you have in your system are saying, I'm getting less orders and making less money, and so I'm going to leave. And then you get into this vicious cycle, right? So that's option one to improve your P&L. Shrink yourself into cutting costs, or lay people off, shut down dark shows, things like that. Which, in some cases, is important, right? If you've overhired, you do need to lay people off, right? It's the reality. Or if you launch dark stores irresponsibly, you do need to shut down dark stores, right? Those are. It's not a bad thing, but I'm saying you can get caught in that vicious cycle. Now, on the side that we're trying to index on is, okay, I need to reduce burn. What I'm going to focus on is I'm going to drive best-in-class execution on the ops and supply chain side, and I'm going to push to drive operating leverage in my backend. I'm going to get more efficiency out of my delivery partners. I'm going to get better IPP in my backend mother hubs. I'm going to get better forecasting and wastage management, right? And so I'm reducing my costs. Now I've got a lot of money that I've saved without touching the business. And I can take some of that money invested back into customers, maybe lower delivery fees, maybe new categories like Zepto Cafe, right? That require capital and are really positive for customers. Now I've lowered my delivery fees, I've bought new initiatives for customers. Maybe I've invested in more assortment, right? And now I'm growing even more. Great, right? Now that I've saved some costs, improved my P&L, taken some of that improvement and invested it back into the customer, I'm growing more. Now that I'm growing more, wait a second, my fixed costs are getting utilized even more. My throughput per square foot is better, and I'm able to drive more operating leverage on my variable costs. So I'm reducing my costs even further with efficiency, and I'm investing that back into the customer. And now all of a sudden I've got a positive flywheel. It's the Amazon flywheel. And so we are trying to be in that category, right, of execution. Obviously, there are some parts you have to take tough calls, but the philosophy has been very clear. Let's build a business that improves costs, not by shrinking yourself, but by getting better and better at driving operating leverage and investing some of that operating leverage back into growing the business and the customer.
How much? It's a quick commerce, from what I understand, it's a very operations heavy business.
Yeah.
How much do you sort of leverage or rely on tech to improve on certain things that you just mentioned?
Yeah, I mean, I think my co-founders are CTO. Both of us come from that background, right? So our DNA is not to try to solve problems by throwing people at them. The DNA is to try to build processes that scale and are done with the right tech. So yeah, I mean, I think right now at this level of scale and the to drive productivity across the supply chain, you start getting into processes that are so nuanced and so specific that the only way to drive adherence against those processes consistently at scale is with tech, right? Tech can give you live tracking. Tech can make sure that the adherence is done well. Tech can also give you guidance for the folks on the ground so that there's no confusion or lack of clarity, right? And so tech is pivotal on the backend supply chain. But now one of the things that I think we could get better on is on the customer side, the tech that we're building there, which we're improving, and we brought on board some solid leaders to get that done. But currently, I mean, and so far the roadmap has been a lot of the operating leverage that I'm talking about is just by getting better automation and getting better process adherence to the pieces that we built on tech.
Okay. Zepto also has a reputation for to have been able to hire senior industry executives who were even in the FMCG space. How did you pull that off? Like to get very seasoned executives to come and work. Say a couple of years back, it was still a relatively new concept. Just take us through that.
Yeah, I mean, the answer to the question is I got very lucky and I'm very grateful.
Yeah.
But no, we got a very solid team, and that team has not only helped us build the business in the right way, where the fundamentals are in the right place, and now it's just a journey of getting to the end of that process. But also it's helped me grow as a founder and as a leader. Right? I mean, I think you spoke to me a year ago versus you speak to me today. There's a difference because you're learning from I feel some of the best operators in startup India right now, in my mind, right? And yeah, I mean, I think how did we bring those guys on board? what we indexed on is we try to get people that were excited about building 0 to 1. You'll find a lot of people that are senior in their career, maybe at a larger company that are managing much higher scale, but at some point in their careers were part of the 0 to 1 journey. Maybe you'll find somebody at Flipkart that is there today, maybe he's a VP level senior guy, but he was there in 2014 with Sachin and Billy building this out, right? So when you ask people like that, what's the most meaningful part of their careers, everyone will always tell you that 0 to 1 journey. People who have gotten a taste of that, they fall in love with that process. And so we try to bring on board people that had that experience of managing scale and had discipline, but also a part of those 0 to 1 journeys. And we said, hey, look, this is an opportunity to do it again. And not only is it just any random opportunity to do it again, but come and take a look at this product. And when people came down to the Bandra dark store and saw the product in the flesh, they were like, holy cow, this is amazing, right? And this is a product life I can imagine, especially back in the early days. I can imagine it be scaling. And I remember there was an ED journalist actually, I'm in touch with still, the Purva. That was one of the first few folks that were using the app, and she tweeted about it because it's that compelling, right? The product experience, especially back then when it didn't exist. So, yeah, I mean, I think that's my thought process. It's get folks that have got experience managing scale, but are also in love with the 0 to 1 process. Show them this is not just any other 0 to 1 opportunity. This is a very compelling 0 to 1 opportunity. And then they can pattern match and say, wow, when I was at Flipkart or Uber or whatever company, right? This is how it felt. In fact, maybe it feels even more exciting. So that's how we brought people on board. And, it also involved giving them a lot of ownership in the company financially and also from a responsibility perspective. And when you give people that mindset to say, okay, I can build my company along with these guys and they share my vision, it's sort of a great meeting of minds.
Got it. Interesting. And so what you said, you've learned a lot of things from these senior hires. What has been some of the top learnings between these two cycles of funding? Can you take us through that?
I think you always need to have a plan where you're not dependent on investors, right? And that needs to always be the base case.
Okay.
I am not dependent on investors anymore, right? Like to sustain my business. If you don't have that mentality to say, I'm starting, whatever I do, I need to have a base case to execute where I no longer need investors. I'm free cash flow break even in a reasonable amount of time. Maybe not tomorrow morning, but in a year and a half, 2 years. That's not a nice to have, good thing to have. It's core. Right? You need to always be executing that position because you don't know when times will change. You know how fast things change between 2021 and 2022. And so I think in 2021, although we were pushing for unit economics, we didn't imagine a world where, we didn't imagine the world where we would never raise capital again. But now I'm operating with that base assumption that I will never need capital again if I do these certain things right. And that's the direction I should move in. Now, that doesn't mean that I will never raise capital. That means that I can not do that if push comes to shove and the world really ends, right? And so that I think is the biggest delta between 2021 and 2022. That's the thought. Like we want to do that. Can I tell you today we can do that for sure? I think we're close, right? But are we there 100%? Not yet, but we're close to that point.
Got it. Okay. I just wanted to go slightly deeper in Zepto also. I remember typically the case is a lot of US and Europe models are implemented here. And models are also based on sort of VCs also model them before investing. But I remember in one of our recent conversations, you mentioned that actually the model in India is working, is the base model compared to say even a US or any European country. Can you help us understand how that is different?
Look, this model works a lot better in India because India has just got a lot more density, right? And so you can do more throughput per dark store. We do 3 to 4 times more throughput per dark store on average than the Western guys, just purely as a function of the density that we have in our buying clusters, right? And I think that's a fundamental tenet of this model, right? And so I don't see it working I think it can work, obviously, right? With the right execution. I think it can work in the West, but it doesn't work as well as it is right now in India. Not just for us, but even for our competitors. It doesn't work as well without that overwhelming density. So yeah, which is the good news is that density is getting more and more. Right, we're going to become the most populous country in the world this year. So yeah.
But how do you solve other problems, say Indian market has, which is peculiar, is people don't want to pay a lot of delivery charges beyond the point. They want more discounts. How are you handling that?
Look, it's a good question. I think I would say the propensity to pay, there's definitely a delta between India and Europe and the US, but the cost delta is so much higher than that, right? So if my propensity to pay of a customer is this much lower in India, my costs are this much lower in India. So I still end up with a pretty healthy arbitrage. Right? If you look at cost of labor as a percentage of sales for retail companies, it's one of the best in India, in the world, right? Which is needed for a country that wants to be a high growth economy that attracts, that attracts the level of foreign investment that we are, right? And so yeah, that's my thinking right now.
Okay. And overall Zepto, I mean, all of us have written about it. There is a lot of conversation still going on. How does what are the plans for Zepto in 2023? How do you sort of plan to scale from here on? You mentioned about Zepto Cafe also. I'm not sure a lot of people know about it.
Yeah.
Why don't you tell us?
Yeah, look, I mean, the plan for 2023 is that same flywheel, right? Reducing costs, invest back in the customer, grow, use the throughput, and reduce costs further and keep the flywheel going. That's just the plan for 2023, right? And for us, like I mentioned, we want to operate with the base assumption that capital is not coming, right? Even if capital does come, great, but it doesn't come, we don't want to be dependent on it. And yeah, we're trying to get to that point. So it's a combination of those two things. And the way to not being dependent on capital doesn't mean cutting your top line in half and reducing your burn as a result, because that's not sustainable either. When you talk about sustainability, a company that's flatlining on growth and losing money, that's not sustainable. Right. Because the only acceptable excuse to lose money in any business context is because you want to grow. That's the only acceptable context to lose money. Right. And so if you're losing any money, even if it's a very small amount and you're not growing, there's something that you're doing wrong. So yeah, that's the thought process for 2020.
Okay.
I think, but in terms of the new things that we're doing, again, part of that whole flywheel, right? The Zepto Cafe is an example of investing back in the customer and getting leverage out of it, better AOVs and better margins and better customer experience. It's, not at odds with each other. A better AOV and a better customer experience, they, in many cases, not all, but in many cases, are the same thing. And so, for us, you mentioned Zepto Cafe, we're scaling that up across the country. A lot of people, there's a lot of buzz about fast food delivery, right? We've actually stuck to our guns. We've brought on board very solid leaders from the F&B space to help us build this. And we're seeing some good results on the unit economics. We're seeing some good results on the scale-up journey. We've launched now, 8 cafes across Bombay. And now we're scaling, hopefully, to more over the next couple of quarters. So, cafe where you can pick up coffee, tea, and snacks along with the groceries is going to become a part of the conversation in 2023, hopefully. So, yeah.
Okay. So lines are kind of blurring in a sense from quick commerce to food delivery also. I mean, I know it's not really meal foods, but like snacks and beverages.
Yeah, I mean, I don't think of it that way. Obviously, food delivery guys have done a good job in their space and really build a product that people use and love. I think for us, it's not so much to get into that space. It's more so, it's just what customers ask us. They said, while they're picking up their groceries, sometimes they pick up chai along with that. Can you do that in Zepto? So yeah, let's do it. It's as simple as that. I mean, actually probably one of the things that I can improve on is, sometimes you can have this grand vision, and sometimes it's important for founders to have. I just talk to customers and they tell me what to do.
Right.
So yeah.
Cool. So Adit, also today the context of our conversation is also on Startup Day. And before we let you go, what's your? I mean, a lot of people do look up to young entrepreneurs and companies that have kind of scaled fast. What's your one message to entrepreneurs who might be listening to you right now?
Yeah, I mean, make sure you're building a company for the right reasons. Right? A lot of people read about startups and how huge valuations and big investors and lots of growth and it sounds great and glamorous, but it is difficult, very difficult, right? Even today. And I think the position you're in is, if you're starting a company, there are going to be some very low lows. There will also be some very high highs, but there are going to definitely first be some very low lows, especially in the earliest parts of starting a business. And so if you're doing that, and your motivation is glitz and glamour and money, when you're at that breaking point, those motivations will not be strong enough to push you to persevere. But if your motivation is more intrinsic, I love the product that I'm building. I genuinely believe it's great for customers. I want more people to see this, right? That is something that actually gets people over the toughest of times of building a company. So when you're thinking about starting a business, really ask yourself, what are my intentions of starting this company? Do I want this big, crazy life of an entrepreneur? Because trust me, if you even get there, you'll still be stuck with tons of difficult problem statements day to day. But if you're really thinking about what's your, like we really think about what's your motivation, and it's something that is more intrinsic, you love building and you love the product that you're building, then I think you're gonna have a much better time building a business. So that's my recommendation to founders. Just make sure you're building for the right reasons.
Yeah, no, that's very interesting. A lot of folks do go solo also while starting up, but we have seen a common trend of having two co-founders. Does that help, especially when there are many lows in the beginning?
Absolutely does. And I don't think I think without Cavalier, there's no way I would have been able to build this. So yeah, it would have been much harder.
Right. Okay, Adit, thank you. Thanks a lot for taking the time out. It's a great chat, and I'm sure a lot of important takeaways for everyone here. And yeah, thank you. Thanks again.
Thanks, Digvijay. It's wonderful being here, and again, really appreciate the feature, and yeah, looking forward to reading this.
Sure.
All right.
Okay. Bye.
Indian startup businesses are shaping the new digital economy. And while the going is tough with a global economic slowdown, let's listen in to their thoughts on the challenges they face, the support they seek, and the opportunities they believe will drive their growth.
Congratulations to Startup India and to all the entrepreneurs and teams building in India for India and for Indians today. It's been 7 momentous years to Startup India, and these years have been very defining for the ecosystem overall. 2 things have happened. One is that in the last 7 years, you've seen more than $130 billion of capital come into the startup ecosystem. In fact, last year alone, we recorded $24 billion. We saw companies go public. We saw retail investors and institutional investors now appreciate the role and the opportunity in India and of Indian startups. And I think number 2, you saw India kind of break through and become the 3rd largest startup ecosystem in the world. There are more than 80,000 startups registered and government acknowledged in India alone, and that is no mean feat. So, congratulations overall. I think there are miles to go, but I think these 7 years have been really amazing, and I can't wait to see what the next 7 years bring before us. In terms of what I would love for the government to invest more time and efforts in, and it's already doing a fabulous job with Digital India, with the women entrepreneurship initiatives, etc. But I really am hoping that 2023 is a very defining year in helping the stories of more and more women break through into mainstream narratives, into mainstream press, and into mainstream conversations and fundraising conversations in particular. Because the reality still is that while of course we have amazing women entrepreneurs building in India, there is still a deficit of funding going to women-led startups. And you have less than 0.2% of funding going to women-led startups in India, which is abysmally low and needs to be corrected. The correction will only happen if investors and the government come together and entrepreneurs come together to celebrate more and more stories of success of ventures led by women. For the Glamm Group, 23 is poised to be a super exciting year. Last year, we stepped foot globally for the first time. So we launched operations in the GCC. And this year will be a very, very exciting year for us because we really look to definitively scale our operations and our sales globally and our business globally. So yes, I think, it's almost symbolic of the aspirations of Indian entrepreneurs today, which is global aspirations from day one. While you're building in India and you're a bunch of Indians building, you do have the aspiration today as an Indian entrepreneur to dominate the world. And I think last but not least, in terms of, words of inspiration for young entrepreneurs in India, do keep in mind that India in the last 7 years itself added about $1 trillion in its consumer growth, and the next 2 years we're expecting to be a $5 trillion consumer economy. So, the future is amazing in India. You have a demographic that's extremely aspirational, extremely hungry for new products, better services, and at competitive costs. So, keep at it, do what you're doing, have the grit, the resilience, determination to continue building in India, and know that the future is in India and that you are creating the future for India. So all the best, and congratulations again to all of us who are building and co-creating the startup ecosystem.
So the government's efforts to boost startup culture and startup mentality has brought in a self-reliance and independent mindset in our today's youth, a sense of self-employment and being an employment provider is high amongst the Indian youth today. To further augment this, I believe that the government at policy level needs to boost support for the fintech sector, which has global scalability and appeal. If India needs to increase its global dominance in the world, that it can be done via finance. Take any significant global power that they have done the same and have increased their global dominance via turning into a global financial power. And fintech is one of the tools that can capitulate India's global financial dominance. Government needs to boost the Indian fintech startups so that they can create a CC Avenue PayPal kind of a global fintech payment giant from India, so that the government has to ease its regulatory compliance for fintech startups, provide it easy funding, and allow startups to get government projects easily without less of bureaucracy. Public support in the form of low-cost funding will be the key to Indian fintech startups going global. After taking UPI to the global level, now with policy support to all startups via the low-cost funding, the country can push them into a global player, which I believe will play a very key to India's dominance on the global stage. Our flagship brand CC Avenue has been a pioneer in the fintech solutions for over 2 decades. We have been the first listed fintech in the country. This year we have come out with CC Avenue Tap Pay. It's a mobile tap POS app for the first time in a country which converts any simple NFC mobile into a digital POS. We have already enabled more than 60,000 merchants with CC Avenue Tap Pay, thus freeing them from the burden of betting the traditional POS machines. We hope all merchants, big or small, or even the kirana walas with this innovative payment technology and make them, self-reliant, get them free from the traditional bulky, costly POS terminals through the CC Avenue Tap Pay. Well, my advice to all aspiring and young entrepreneurs is to think about global scalability. India is a big consumer market and it has enough to support your startup business. So, you should start locally, expand locally, and then go global. Like our company, Infibeam Avenues, is the apt example of starting locally, expanding locally, and then growing global. We are present in India, UAE, Saudi Arabia, Oman, Australia, and US. Thank you.
Hi, my name is Ram Ramani and I'm the co-founder of CredAble, which is India's largest working capital tech platform. My advice to young entrepreneurs today is to build a business that is sustainable and profitable. Given today's challenging capital raising environment, profitable business is key. Moreover, the business model that they should follow is the one that brings an incremental value to all stakeholders within the ecosystem, and that will include your customers, partners, employees, and investors. More importantly, young entrepreneurs should look to bring in a strong management team to help them realize their vision. Also, a management team that brings in the agility to deliver within a challenging working environment and who are aligned to the company's culture statement. Given that today there are more than 85,000 startups who are increasingly contributing towards the economy and the workforce, the government should put in place policies that enable these startups to get access to working capital more efficiently so that they can grow substantially.
Well, that's it from all of us on this special National Startup Day presentation of economictimes.com. Do check out our budget special and other programs. But from all of us, thanks for watching and goodbye.